Good morning, everybody. Welcome to the game plan. My name is Gareth Soloway, Chief Market Strategist here at VerifiedInvesting.com. So we have a lot to cover again today. We just got PPI data, which is Producer Price Index data that's following off of CPI that came out yesterday. Jobless claims came in around expectations, about 220,000. But we're going to walk over and take a look at these PPI numbers here on the big board. So the PPI numbers confirming yesterday's CPI data coming in lower than expected. And remember, lower than expected means lower inflation. So that's good, or at least less than expected inflation. So what we have today is PPI year over year. That's Producer Price Index year over year coming in at 3.2%. It was expected to be 3.3%. PPI month over month, 0.0%, much better than expected. Forecast had been 0.3%. So again, overall, this is good news that inflation is starting to kind of stall out from its push up, at least for this month. The problem again remains, and why the markets are up only a little bit off of this data, is that we don't know what the impact of tariffs will be yet on inflation data next month. And again, generally, this is probably not including any of the tariffs yet, so we have to watch that for next month. And I think that's what the market will hold its breath for going into next week now, or next month. Now, a couple things to go over here. Number one, we have the S&P, which did bounce a little bit yesterday. Yesterday in the morning video, or in the morning game plan, we talked about how the S&P is at support. You can see this secondary trend line that I found as well from this pivot low right here through the low here in August, coming right up to this level right there, right? So again, you can see again right there, that trend line coming through here, and that gives us a basis as well. In addition, remember yesterday I showed you the parallel. If you connect the high here to the high right there, it's a slight upsloping trend line, which then if you expand out, it connects perfectly through this area too. So this is basically a parallel here. And so again, it gives us a technical reason why the market should bounce, not just, oh, it's oversold or we think it's oversold, but more so, okay, there are some levels here that the market is going to try to hold based on technical analysis, all right? But again, the question is, how long does it hold? You know, if the trade wars get worse, and I'm hearing every day, you know, a new threat of 200% tariffs on Europe in retaliation for this or that, it's ultimately the straws that are breaking the camel's back, if you will, in terms of psychology for investors, right? Investors get tired. One of the big principles of investing is that the market and investors can handle bad news and they can handle good news. What they can't handle is uncertainty. Uncertainty because you can't price out a model for how much should we pay for this stock in terms of earnings per share, or this stock when we don't have specifics. And so when things are always in flux, it ultimately kind of deteriorates the market psychology, and that's what we're continuing to go over. In addition, you throw out names like Walmart. We've seen the kind of the warning going on there. We just had Delta warn on earnings. There's definitely a slowdown, what I'm going to call, and I'm going to again talk about this more and more in the coming weeks, the reverse wealth effect. So again, if you remember, one of the reasons why the markets were just grinding higher and the economy was staying kind of abnormally strong for such a long period of time was that as the markets went up, and I explained to this many, many times, is that people are sitting there and saying, oh, wow, my 401k is up another 5% this month or this quarter. I guess I can go buy that new TV, or I can go buy a new car, or I can go take a vacation. Well, now we're getting into this point where since December, we haven't seen that. So people are looking at their statements and they're saying, wow, I'm flat, or now I'm down. It's the reverse wealth effect. And so they're going to start to pull back on spending even more ferociously. And that, again, will cause an issue. Now, a couple charts that I wanted to show you guys here. I wanted to show you this chart of the S&P 500. I've shown you guys these before, but they're starting to mean a little bit more. When the markets were at all-time highs, everyone kind of looked at these charts when I was showing them and kind of warning about the market and saying, wow, this could be, you know, this could just be nonsense, right? But if I walk over to the big board and we look at this chart of the S&P, this is using a logarithmic chart going back to 1929, and we look and we say, wow, look, the high of 1929 before the Great Depression, okay? Right here, you connect it through the dot-com high right here, and then you have the dot-com collapse. And look at what we just tagged. And I know I have to zoom out so far that some of you guys may not even be able to see this, but that line literally got tagged in December on the logarithmic chart. And again, these things have an uncanny way of guiding us to what we should expect when we look at technicals, right? So again, we are at the high of that. We've already started to come off, and you have to wonder, is there something bigger brewing here? If this line was the dot-com collapse, if this was the Great Depression, and again, maybe not as bad as any of those, hopefully not as bad as any of those, but as a technical trader and just someone who manages my own money and my own family's finances, I have to be aware of what this could signal right up here in terms of the outcome of maybe what it yields, all right? So again, things like that, very important. In addition, another chart that I think is very poignant to take a look at is the NASDAQ composite here. And if we look at the NASDAQ composite and we flip it back to regular trading, right? So let's go back to regular trading on the NASDAQ here. And we go to our weekly chart, and let's get rid of all of these lines. And if we take a trend line right here and we connect it through these lows, okay, what do we end up getting? And again, I'm going to use my parallel tool here. We take that and we drag it up, and again, look at that. So the low from COVID to the low of the bear market, the high of the bull market in 2021, and look at exactly right up there what we tagged in December right there, and look at what the market's doing. And again, these are just guiding points, and I always want to stress that, is that, you could have, listen, there's a chart can point to anything potentially. It's about looking at it, thinking about it on a logic basis. When I was back in December, when I was saying, hey guys, we have a cycle date on December 16th, that could mark a major turning point in the market. It happened to be right at basically the all-time highs of the market on the NASDAQ. And when I was looking at these charts that I've just shown you, I wasn't saying, oh, these are gospel, let me make sure to take these, and this is definitely what's going to happen. But what I was doing is I was saying, okay, now let me look at the valuations on stocks. Let me look at the psychology of investors right now and the risk taking that's going on when you're seeing, crypto going crazy and all of these other things. And essentially what you're doing is you're following the breadcrumbs, and it allows you to kind of make educated decisions and probability analysis, which is what guides us to good investment decisions overall. Not always being right, but just overall being right more than we're wrong. All right. Let's take a look here. Adobe getting crushed on earnings. By the way, folks, we've had not a lot of earnings. We're not in earnings season. But one thing I will say, folks, it is very hard to find a stock that really has a big move up on earnings these days. Most stocks are going down, 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 and it's mostly on guidance. So Adobe falling sharply, down over 6% here, trading near 400. I was looking at the chart here, and there's a big upsloping trend line. This one, to me, going back to 2016, this is around the 350 to 355 level. That's $50 lower than we're currently trading. I don't think we deal with that on a day trading basis today. But as a swing trade, that actually could be a good level if it gets down there. So I'm keeping that on my radar. But on a day trade basis, the level I'm going to watch today, right here, this 385, 386 level, what we can see is this flat top right through here, and that's reasonable. That's only about $15 to $20 lower than current trading. If it fell into that, I would likely be taking a long day trade setup with members in the Apex Live day trading room. Here's UiPath getting crushed, guys. I think this one's down about 20+% on the day. You can see again on earnings, same kind of deal here, the big drop. And now the question is, well, where do we look at this one? And this one, what you have to do is you have to zoom out and you just have to say, okay, well, it's trading basically in the $9 range, but look, it's never been this low. Okay, so the lowest point was a double bottom here at $10.40. But if we flip back to the intraday, we can see it's at $9.40. So it's $1 lower. So then you say, well, how do I find a potential day trading level here? And the only thing you can do is look for downsloping potential trend lines. And I'm looking as we speak in real time here, and I'm not finding anything that's that amazing in terms of a setup. And again, zooming out, I'm kind of looking and I'm just scanning using my eye to draw trend lines in my brain here and trying to go through. But I honestly don't see much here. Not to say that there isn't a level. There's always a level, but it certainly looks hard to find at this point. So I'm going to pass on that for now and just say I don't have a good level for you guys at this point. Sentinel-1, another big drop on earnings. It has come back a little bit in the pre-market here, so that's good to see for that stock, but still down sizably from about 19.5 on a closing basis, and right now trading just above 17. And this one is a little bit easier to kind of find a level on, right? So what we can see here is there is an upsloping trend line right through here. So if we take this low and we connect it through this low, it looks like it's right around 1585 or so. So the low pivot to low pivot. So if this were to dump back down, this would actually be a low even from after hours. That would get my attention right there, with a subsequent level around $15.14. Obviously a double bottom here around 1435 or so. But again, basically 1585, there might be a tradable level. All right. Now, the next thing I want to do here, folks, is what I want to do is I want to talk a little bit about the potential for trades that don't have news that are driving them, but are getting close to technical levels today. And these are actually some that I might even consider swing trading in today's action. The first one's JP Morgan. JP Morgan, if it flushes out today, excuse me, there's a level between 225 and 221. Gap fill right here and this level. I love stocks that are high quality names that are getting crushed to the downside on no direct news about that company. We all know what JP Morgan is. It's a big bank. It's the biggest bank. And then this level should be a bounce level, anywhere between 225 and 221. 221 would be ideal. That's the gap fill. But again, it might not get there. So what I do is, in general, I start to nibble maybe here and then add at the lower levels, dollar cost average in, looking for a swing bounce. The next one is Walmart. Gap fill coming up at around an $84 pierce. That should be a significant support level. Again, beautiful upsloping trend line marked high, and then look at the kind of the cascade fall to the downside as the consumer, even Walmart consumers, are now cutting back on spending. Again, these are only bounce levels. I want to be clear on this. Quick swing trades, maybe day trades. I think Walmart's going a lot lower. In fact, there's another big gap down here that I think will hit later this year. But on a short-term basis, which is what I do, swing trades are days to weeks, week-long holds. That would be a level. And then Target has just been getting annihilated, another retailer here, but it is getting close to support around 104 to 105. I will be watching this today. There could be a trade level here. All right. Bitcoin. Let's go over to the big board, shake it up a little bit here. So on Bitcoin, we still continue to see pretty lackluster price action ever since kind of this dip and then this pop. It's kind of been settling in. As you guys know, I don't change my analysis no matter what unless the chart tells me to change it. What is the chart still saying? It's still saying we have support here and we have resistance here. Okay, if we come down here, you would expect some sort of bounce around 73,000, give or take. If it confirms below, now the door opens for a bigger drop. But right now, 73 is the support level. Resistance remains right here. You can see we even closed above it on that great news on Sunday. Again, I told you guys on that Monday that there was a reason that Trump released that news about the strategic reserve on a Sunday, because all the other markets were closed. So it focused the most focus on Bitcoin, that it could. The kicker here, though, is, think about this, is how many people jumped long up here because of that hype and that pop. And if it had been done during market hours, would it have been a smaller pop, and then people might not have lost so much money as it came back in? Neither here nor there. It is what it is, as I always say. But the point being is that you have all your resistance at 92 and your support at 73. Unless we confirm below 73 or above 92, this is a range-bound price action, even with Michael Saylor continuing to buy Bitcoin. All right, we'll go over gold and silver now real quick and take a look at what those are doing. And if we take a look at gold, gold is testing this high right here. So this is a big level on gold. Can it break through this 29.55 level? If it does, the odds are raised significantly that we make a push to about $3,035, $3,050 right up here. And I want to be clear, and I've been steadfast on this, whether I've been going, swing trading for a quick short on gold or a long, that's all short term. the mid to long term is still bullish on gold. It is what it is. Like, until the U.S. government proves it can get its act together, until geopolitically things calm down, until the stock market kind of calms down with less risks to price action where people will fly from stocks into the safety of gold, you have to just maintain that positive bullish bias for a mid to long term. Doesn't mean you're not going to have pullbacks along the way, which is how I trade. But again, just be aware, the bias remains bullish overall. Okay? Next up, silver. Silver had a break above this trend line here yesterday. Remember, unless it confirms, it is not a true breakout. It could be a fake out. So again, today as of now, it would not confirm. I will be monitoring. If it does confirm, odds or probabilities rise significantly for a move up to 34.80 and a test of this short-term double top. Okay? Next up, natural gas. Look at nat gas, guys. I talked about the topping tail and how this was headed down. I said the first big challenge on the downside for bears would be this trend line. Where is it? It's right there at the trend line, trading here. Now, I did take half of my position off with smart money commodity members, slightly in the money here. The basic reason is because technically it could bounce here, and then I could just re-enter on a bounce. If it continues to collapse, well, then guess what? We ride that baby all the way down into this level on the short trade. And then oil, folks, we know oil bounced yesterday a little bit. Today, it's coming back in just a tiny bit. I still think there's a little bit more upside to be had on oil before it rolls over, but either way, again, path of least resistance, again, based on economics, based on the drill baby drill kind of mentality, U.S. economy slowing, based on consumers slowing. All of these are pointing to an eventual breakdown on oil below $65 a barrel that likely sends it well south of $50 a barrel, probably by year end or early 2026. So that would be quite something to see oil. Imagine oil down, and my lowest target is about $35 a barrel. We'd all like that for our cars in terms of gasoline, but the problem is, what does it tell us about how bad the economy is if that's the price on oil? All right, guys, I've got to get to my trading room. Always remember, we have one-day passes, so if you just are like, hey, I'm not working today, I have my 9 to 5, I'm taking off, and you want to jump in the trading room and just listen in to us trading live and see our charts and our analysis, ask us questions, all of that, you are more than welcome. Again, one-day passes, we have 1 week passes, and then obviously there's a monthly when people figure out that it's an amazing, amazing service of traders that are, again, we're right about 80% of our trades, I would say. That's probably our overall average. You can see the track record, full transparency, even our big losses. Occasionally we have big losses. That's real trading, folks. Every once in a while you get slammed. The market is unforgiving if we make little mistakes. All right, you guys are the best. Thank you so much for tuning in. I'll talk to you later. Take care.